Hello, welcome to the LTAM Asset Management second quarter market commentary. My name is Phil Blancato. I'm the chair of the Investment Policy Committee here at LTAM Asset Management. Well, if you think about what's going on in the world of stocks and bonds, international, there's a lot of noise in the marketplace. We hear things about Greece and how difficult and challenging that is. There are geopolitical things going on around the globe. There's concerns about interest rates skyrocketing, whether the U.S. equity or the U.S. economy is really doing well. A lot of that to us is noise. What you hear in the media sometimes isn't exactly really what's going on. Our belief that this is the sweet spot for stocks in the U.S. equity market. In fact, I'll start there. We think it's a sweet spot because you've got low inflation, you've got moderate growth. The United States is growing around 2.5%. You got a 15-year low in people looking for jobs, and roughly 6 million people have found work in the last 5 years. The U.S. consumer is actually in pretty good shape. Very low interest rates, saving a lot of money on gasoline. And more importantly, they're actually starting to have some savings, and year-over-year incomes are up over 4%. So while at the beginning of the year we thought the U.S. stock market would be pretty volatile, and it has for lots of other reasons that have very little to do with the facts of the market. So there's been volatility in the marketplace, but by and large, the U.S. stock market's pretty good, pretty healthy. Up a couple of percent through the end of the year. We think it's actually going to finish the year closer to 8%. So something to think about. Strip away some of the noise of the market when you look at the facts. Things are actually pretty good. The June numbers for retail spending weren't wonderful, the ones that just came out this morning. By and large, on whole, consumer spending again. U.S. corporations can borrow pretty cheaply. Second quarter growth is going to be better than the first quarter growth as far as our economy goes. And that's the sweet spot for U.S. stocks. Not expensive, but growing pretty well. The European market's a little bit different. We heard so much noise about Greece. And that Greece is going to leave the European Union. It's going to send shockwaves to the whole European continent. Oddly enough, the facts don't say that. The European Union as a whole is actually out of recession. Projected to grow about 1.5% this year. Their manufacturing is up. It's actually expanding. European stocks are actually up more than double where the U.S. stocks are. Go think of that. Did you just stop for a minute and believe that European stocks are up over 5.5% when U.S. stocks are only up roughly just short of 2%? And yet, all the noise about Greece. Greece to us is not an event. It's a very small economy, half the size of New Jersey. If they leave, they'll figure out a way to extend their debt for an extended period of time. We don't think that happens. Mechanically, to actually let Greece leave, creating a drachma and figuring out what to do with currency and changing computer systems, very difficult. They'll give them some sort of long-term bailout. But in the end, it's not a big deal one way or the other. Europe is up. You're invested in Europe, and we've reaped rewards for it. Emerging markets are a little bit different. As the U.S. dollar strengthens, emerging markets tend to weaken. The global economy is not great. The globe in general, whether it's Europe and the Asian European continent, not really growing that well, all growing about less than 2%. That has a big impact on emerging markets. So as the dollar strengthens, it hurts it hurts emerging market currencies. And lack of global growth hurts emerging markets as well. Though actually stock markets are up a couple of percent this year, but with lots of volatility. So we're out of those markets for now. Maybe somewhere down the road, just not today. Your bond market. Lots of speculation around the bond market. People very concerned about the bond market. Interest rates have gone higher. Why? Because the U.S. economy is growing a little bit. And the European economy is growing a little bit. They've moved actually the second quarter from 1.95% on U.S. 10-year to roughly 2.4% where we're sitting today. That move, that 50 basis points, half of 1% move, has caused the bond market to lose money in the second quarter of this year. We believe that that's normal. We thought that that would happen. In fact, we think the Federal Reserve is going to raise interest rates coming September or October of this year. All that puts some pressure on bonds. But it's a slow, methodical rise in interest rates, not some parabolic move. In order for interest rates to go really high, the U.S. economy would have to be going at 4, 5, 6%, and it's just not. And neither is Europe. So we think a slow, methodical rise in interest rates is what's going to happen, and that's what you're seeing. Don't worry about the bond market. Stay diversified. Make sure you own some corporate bonds, some international bonds, some U.S. bonds like we do in the LTAM program, and things should be just fine. A slow, methodical rise in interest rates. You can survive that through short duration and through overall being careful about how long your maturities are. And then finally, as far as you think about the housing market and where that's at, it's improved. Housing market's improving right along with more or less the U.S. consumer. So we think that's a good bonus or a plus to the overall economy in the long run. So to wrap things up, things are not that bad. For all the noise you hear in the media, for all the things you hear in the papers about how bad things are. The unemployment number has improved. Wages are up year over year. Inflation is still low. You're paying less at the pumps, as I already mentioned. By and large, the consumer's in good shape. U.S. corporations can grow less expensive because debt interest rates are so low. And the U.S. economy is in pretty good shape. The global economy is slowly healing, especially Europe. We think this is a good time to realize there's going to be volatility in the marketplace. But by and large, at the end of the year, we think equities end up higher. The bond market's going to be under pressure, but it should be okay through diversification. And I think for all you're hearing out there in the media, the facts don't say that things are as bad as it's been made out to be. If you have any questions at any time, please contact your financial advisor. We're always available to answer any questions. Maybe meet in person one of these days. Thank you for your time. Thank you for your trust in us. And have a wonderful summer. Maybe we'll see you one of these days. Take care.